So, as a general rule of thumb, when you're dealing with uncertainty in lease terms, we want to look for a certain keyword that will guide our intuition. And that, in this case, is what can we reasonably expect? So, we talked about whether or not the lessee can be reasonably expected to exercise a purchase option, whether they can be reasonably expected to follow a renewal. This will guide what we want to record in the right of use asset and in the lease payable for the lessee. So there are contractual provisions that may allow an option on the part of the lessee to either renew the lease term at the end of the lease term, thus extending the contractual life of the lease asset, or we may have a early cancellation option that is available to the lessee. Well, again, in either case, we want to look for the financial incentive to do so on the behalf of the lessee, whether or not this will make them reasonably certain or reasonably expected to exercise those options. Now, it's worth noting that if the option is in the hands of the lessor, then it's just de facto recorded in the lease contract. We don't wait for a reasonable expectation for the lessor to act in a way. The lessee just assumes they're going to act that way. It's comparable to treating all callable debt as a current liability. It's a conservative accounting technique that says if we don't have that option, then we better act as if the counterparty in the transaction will exercise that option. So there are two types of uncertainty that we want to consider. Uncertainty at the inception of the lease. So, for example, it may be reasonably expected that the lessee is going to exercise the extension in the contract or the cancellation in the contract. Then we just simply want to adjust the full lease term to account for that reasonable expectation. So if there's a 2-year renewal, for example, on the Widgeon and Mallard lease contract, and we expect Widgeon to take that 2-year extension, then we would just treat the lease as if it was a 10-year lease rather than an 8-year lease because we have that reasonable expectation. That records it at the full 10 years. We take the present value of the payments over those 10 years and then record that as the right of use asset in the lease payable. On the other hand, sometimes it may not be financially beneficial or incentivizing for the lessee to exercise a renewal or a cancellation at the beginning of the lease contract, but because of some shifting economic conditions or the circumstances that the lessee finds itself in, its operations, it may now be beneficial. It may now behoove the lessee to extend the contract in the midst of the lease. In this case, then, we're going to want to make an adjustment to both the right of use asset and the lease payable. So what we do then is determine what is the current carrying value of the RU and the lease payable at the date that the renewal cancellation, we'll just say at the date that the option becomes reasonably expected. So we go ahead and just look at, well, what's on the balance sheet now? Then we include the expectation. So in this case, I'm considering the expectation that the contract will be renewed, extending the life of the lease, and therefore adding to the present value of our lease payable and also the present value of our right of use asset, because we're going to use it longer, we're going to owe more money, we're going to pay more rent if we extend it. Well, then if we calculate that present value of the extended contract as $500,000, then we just take the difference between the two and realize that we need an adjustment of $200,000 in order to set this contract to rights in terms of our expectations. That then leads us to make the following journal entry, increasing the right of use asset by $200,000 because now we're going to use it for 2 additional years, getting more economic benefits from it. And then also increasing the lease liability because now we're going to have to make 2 more years of payments to the lessor. That will increase our obligation in this lease contract. Of course, if we're doing a cancellation, we would do much the same, except that it would probably reduce our right of use asset and also reduce our lease payable. It's worth noting that only the lessee is allowed to make these judgment calls concerning renewals and cancellations that are in its option, that are in its purview, right? Its option to exercise. Lessors will not record a change given shifting circumstances for the lessee. They won't increase their lease receivable. They will do it under certain circumstances, and we'll investigate those in a bit with lease modifications. But with regards to the uncertainty and options within the lessee's purview, they do not do so. There may also be uncertainty in the lease payment. And you're probably most familiar with this in terms of a car lease, where the lessor, the car company, wants to restrict the mileage you put on the car in order to tamp down the risk of you decreasing the depreciated value of the car by driving it all over the place. Well, this enters into an uncertainty on the lease payment, because if you do exceed a certain mileage, then the company will charge you extra lease payments. So it allows a sort of sharing of risk, such that the lessor now bears less risk from the lessee in certain situations, i.e. the car example, where they get an asset that has been depreciated more by overuse. Sometimes it helps share the risk in both situations, where a retail location, maybe we're renting out a store location in a mall, and we will owe our lessor more payments after we exceed a certain amount of sales. Now, that might seem not exceedingly fair in some ways. However, this also provides incentives for the lessor to keep the grounds in a kept state, so that it increases traffic in the mall area, to advertise more for its lessees, so that they can share in the revenues that the lessees create through their stores. So these are certain, there are certain risk sharing benefits for both parties depending on the contract of the payments and how they're going to change over time. Now, these items are avoidable and uncertain, so we just account for them as expenses and revenues if and when they're incurred. They're not going to be capitalized. They don't enter our payment stream, and so they do not actually affect the lease payable. Now, there are two exceptions to this. As always, we have a few exceptions in accounting. When the variable payments are in substance fixed payments. So what does that mean? Well, for example, maybe lease payments will increase by $10,000 or 1% of yearly sales revenue per year, whichever is higher. Well, in this case, we have a fixed payment in substance because we know we're going to pay one or the other. We know that they're going to increase by at least $10,000, and so we would record that in our initial assessment of the lease. So, for example, we would have a payment, and then the next year we would have a payment plus $10,000, and then in the year following we'd have a payment plus $20,000, all the way up. And we would want to capitalize this stream of payments, this stream of increasing payments, to figure out what the present value of the right of use asset is, as well as the lease payable. Also, an exception is lease payments that are tied to public indices or rates. So, for example, perhaps the payments are tied to the CPI. Perhaps the payments are tied to GDP. Any of these sort of publicly available indices, we want to capitalize the initial effect at the signing of the lease. So whatever the payments are, we modify them by the current indice or the current index or rate, and then we put that into our ROU or lease payable. We ignore any changes over time. So we only do it given the current economic outlook that the index or the rate is describing to me when we sign the lease. But if that changes over time, we don't consider it unless we make an adjustment, as we saw before. So if we make an adjustment for a renewal, well, then we update our priors. We say, well, at that point of renewal, when something becomes reasonably expected to be used, what then is the current index or rate at that moment. But we don't change it unless we're changing something more fundamental in the lease. So as I said, sometimes there's a modification of the lease term. And that is when two parties come into agreement, the lessor and the lessee, come to a mutual reassessment of the contractual terms. And not just the lease term in terms of the years, but the contractual terms. So this could be number of years and payment. It could be one or the other. But the big hallmark of this situation is that the lessee and the lessor are both coming together to do this rather than just an assessment of the likelihood of occurrences, right? Because prior to this, we said, well, maybe the lessee is likely to renew or cancel. Well, that's not even a part of the this modification isn't even a part of the contract to begin with. Rather, this modification represents something totally new. If the new contract that the lessee and the lessor draw up is a modification that confers additional rights and benefits, then we need to capitalize a new lease. Very simple. For example, perhaps we have adjoining properties that the lessee is taking over. Perhaps there is additional hardware on the equipment that we are leasing that changes its capacity. Well, then we'd have a new lease that we want to capitalize. Perhaps its productive capacity has changed as a result of these modifications. Anything that has new rights, new benefits, is going to be different. If it is just extra years, if it is just an adjustment in the payment, but nothing else underlying in the right of use asset is changing, then we adjust the lease payable and the right of use asset and the lease receivable, because now both parties are going to make adjustments. Then we have to all change the current lease rather than create a new lease. So I go ahead and give you an example that dovetails off of our old one, Mallard and Widgeon. So suppose that on January 2nd, 2024, after the payment is made on January 1st, 2024, they decide and agree to change the contractual terms. In this case, they stipulated an additional 2 years on the lease term with a reduction in payments for the remaining. There's actually only going to be a remaining 4 payments at that point. I had to alter this example slightly. So I ask you to provide a journal entry to adjust the lease terms for both Mallard and Widgeon at that date, at January 1st, 2024. So remember, we have a lot of things to consider here. At 1/2/24, there have been how many payments, right? There have been one. It started on January 1st, 2019. That was the very first payment on our annuity due. 2020, 2021, 2022, 2023, 2024. So there have actually been 6 payments made, which means that there are 2 more remaining under the current contract. So you have to sort of get an idea of where you are in this lease contract. Well, if we're putting on an additional 2 years, that's going to represent 2 more under the modified. Which would actually make a full 10, because we had 6. We had 2 remaining. We're adding 2. So now we have 10 payments, or I'm sorry, 10 years of the lease contract. And also a 10-year useful life. Now, why am I going through all of this? Because in this example, we started with a financing lease to the lessee and a sales type lease to the lessor. So unless we're talking about a reduction in the years, which we aren't here, we aren't going to go from a financing lease to an operating lease. However, it's important to note that this modification could change whether the lease was in substance a purchase or in substance a rental. So we do have to be aware of that. That's why I would go through and make sure that it still meets the terms of the current lease. Well, we have at this moment, prior to the modification, we had a financing lease, a sales type lease. We're still going to have a financing and sales type lease at the end of this modification. Now, let's actually assess what the modification is going to do. Remember, we have to figure out what is the carrying value of the lease payable at this point. So we're at 1/2/24. So I would go back to that amortization table and then locate what the carrying value is at that date. When you do that, you'll find that the carrying value at that date is $36,090 after that 1/1/24 payment. So that's the carrying value of the lease payable at 1/2/24. Now the question becomes, what do we want? What is the desired present value based on the fact that we're going to extend this contract? Well, we have 4 more payments. And we have an I of 10%. If we have 4 more payments, that means our N is 4. Our payments have changed. So we have payments of $19,500. We don't have a future value in this lease. And so we can figure out what the desired present value is based on the fact that we are now at 1/2/24, and we have 4 more payments since we added 2 more under this modified version. Now, be careful. Do you want an annuity due or an ordinary annuity at this point? Think about it for a moment. We just made a payment on 1/1/24. We're now at 1/2/24. When is the next payment going to come? Unless the next payment is going to come at today on 1/2/24, then we have an ordinary annuity now. That's how we want to measure this lease, because the next payment is going to come at 1/1/25, a year from this date. So make sure that you assess the present value with an ordinary annuity. So you really have to be nimble with your time value of money skills, really know how to apply them in order to do this sometimes. Well, after we figure out that present value with the ordinary annuity, 4 payments left, with the new payment terms of $19,500, we should get a present value, a desired present value of $61,812. Which the difference between them would be $29,598. This is our adjustment. So this is how we would want to adjust the lease contract at that point in time. We would then debit the RRU asset because it's an extension of the contract, even though it's a slight reduction in the lease payments. For that amount, $29,598. And the lessor, in this case, is going to record a debit to the lease receivable, increasing the amount that it expects to recoup from this extension. And now the question becomes, well, what do they want to credit? They don't have any asset left to credit. Remember, this was a sales type lease, so the asset is already off their books. In this case, they would want to record deferred revenue of this amount. My debits and credits are going to overlap just a bit, but that is a credit. And they can recognize that deferred revenue over the next 4 years of the contract. right? They don't want to recognize it right now because it's going to be paid to them over the next 4 years, and they will earn it over that time. Would we provide the journal entry for 12/31/24 and the payment on 1/1/25? Well, then we need to use the new lease amount. Remember, we desired this PV. We adjusted the ROU and the lease payable. So now the lease payable after this adjustment is equal to 61,812. We multiply that, because that's the new carrying value, by 10% to get our new interest expense for this year. So 6,181. Interest payable, 6,181. Now remember, we didn't just alter the lease payable, we also altered the right of use asset. So we need to go back and look at, well, what was the right of use asset at 1/1/24? At 1/1/24, the ROU, according to the amortization table, was 45,763, and we just added 29,598 to it. So that creates an ROU at that point of 75,331. So we updated the book value of our right of use asset. We are then going to depreciate it, or amortize it in this case, over 4 years. So that changes now the amortization schedule for my right of use asset. 18,833. Now let's look at the lessor. Well, the lessor is a little more simple, simply because they increased their lease receivable. Because the lease receivable and the lease payable in this example were the same carrying value, they would go up as well to 61,812. So the lease receivable after adjustment is going to be equal to 61,812. Well, that's the carrying value that we're going to use to determine interest revenue for 2024. So then we just have interest receivable, interest revenue of $6,181. The other thing that the lessor can now record is a part of this lease receivable, because we adjusted it, and now they record some over the next 4 years. Again, we can just straight line this. So 29,598 divided by 4, and it's a new account. This just came or arose from the modification, so we don't have to add it to anything, not like we did the ROU. They had no deferred revenue account prior to this, and so we can recognize deferred revenue, debit it 7,399.5, and record lease revenue. So reducing that liability and increasing our net income. Okay. The payment on 1/1/25, I didn't really leave myself a lot of room for. However, I think you've seen this enough times. I'll do it from one perspective because I have about room for one of them. I'll do it from the lessee's perspective, where they're going to pay cash of $19,500. Remember, that's the new payment. Oops. Oh, crap. I thought I had more room than I did. $19,500 is the amount of cash they're going to pay. That's going to pay off the interest payable first for $6,181, which is going to leave them with an amount to pay off the actual lease payable. So $19,500 minus $6,181 gives me $13,319. That's the lease payable. That gets reduced. So this is a really complicated, complex process. I want you to know the steps to do it, the underlying concepts behind it, determining a carrying value now, determining a carrying value that's desired. I will, if I was to do something like this, I would give you the amortization table so that you didn't have to calculate what the carrying value is a certain time into the lease contract, et cetera, et cetera. But you should know the general way that this is modified. And like I said, this is probably the tougher part of, one of the tougher new pieces of the lease that they've added to the standards. Okay. The next topic is about residual value. Residual value is a very interesting piece, and we've touched upon residual values to some degree throughout the lectures to this point. A residual value could be, for example, a BPO. It's a different sort of residual value, but really the residual value that is most common is going to be the one that the lessor expects. It's simply the commercial value or the fair market value of the leased asset at the end of the lease term that we expect to recoup. So for example, if I leased a car and I leased it for 5 years, I expect the car to be worth $30,000 at the end of the 5 years. Well, then that is my residual value as the lessor. I expect to get that car back at that market value. So it could add some additional protection to the interests of the lessor. It yields an incentive for the lessee to take care of it. But the interesting thing is that the lessee is not required to guarantee it unless it's written into the contract. So we're going to look at what happens when the lessee is required to guarantee it. But like I said, that's not necessarily going to happen unless it's written to the contract. It's a more likely item in operating leases. Rentals are unlikely to span the entirety of the leased asset's economic life. The lease term is likely to be less than 75%. And for that reason, the commercial value or the economic value to the lessor is likely to be of a greater amount because the lessor is going to take the leased asset back, release it for another period of time, perhaps do it again, right? And so for that reason, the leased asset is returning to the lessor with some economic life remaining. If the residual value is very high, it is likely to trigger criteria number 4. It's likely to affect criteria number 4 because the lessee does not have to record it as a future value. So the FV equals 0 unless lessee guarantees it. So what's going to happen then is the lessor will think or expect to get back a residual value, but because the lessee is not required to guarantee it, the lessee is not going to record it as a future value. The lessor records it whether or not it is guaranteed, which is interesting, and that usually causes students some intuitive dissonance, some cognitive dissonance when they're considering this. Well, why is the lessor recording a future value if it's not guaranteed to happen? I get it, and we do, all right? So remember that in substance purchases may also contain residual values because it's just in substance of purchase. It's not an actual purchase. Because we have criteria 3 or 4, right, where the lessee is not expected to take ownership, the lessee will still have to return the leased asset to the lessor, even in an in-substance purchase. Of course, residual values are ignored or not applicable if we have a bargain purchase option that's likely to be exercised, or a transfer of ownership. That's criteria number 1 or number 2. And we'll look at what happens in the case of a bargain purchase option as well. So what are the effects of a residual value? The first effect, or the first moment effect, is what the lessor is going to require in terms of payments. So remember that the lessor schedules the payments of the lease contract to obtain a specified rate of return. So they set their rate of return. They know they want, for example, a 7% return on an asset that they know is worth $120,000. Well, let's take it into terms of our original example. If we hold the rate of return constant, so we hold the 10% that Mallard was wanting to receive from this lease contract, then what Mallard is wanting to recoup is the $122,034. That is the fair value of the asset. So Mallard is going to want to get that through the contractual terms of the lease. Well, if we consider then that Mallard is going to expect a residual value, let's say that they expect $20,000 of a residual value, well then what is the present value that they're going to get from expecting a $20,000 residual value from the return of their asset in 8 years at a 10% rate of return? We're not considering the payments, so we zero them out. Well, this is the amount that Mallard will get from just the return of the asset. Assuming that the asset's going to return to us with a $20,000 residual value. Then all Mallard has to get with its payments is $112,704, because it wants the full fair value of its leased asset. It's going to get $9,330 of that with the asset's expected return value. Well, then it only needs $112,704 from the payment stream. So then we solve with a present value of $112,704 for the amount of payments. Again, we already have the residual value of the asset, so we set that to 0 when we're solving for the payments. An I is 10 because we still want a 10% return, and we're still going to earn that return over 8 years, and solving for that gives me $19,205. Okay. So we need less payment because we're now expecting to get the asset back at a expected residual value. Right? So the first moment of effect is to decrease the amount of payments. When the lessor records a residual value, and they do so whether it is guaranteed or unguaranteed, it's going to decrease the amount of payments they need, holding all else equal, holding the fair value of the asset equal, holding the return they expect equal. So let's look at the next effects. Well, what are the effects of the accounting? Remember, the lessee is only required to consider the rental payments. They set their FV equal to 0 unless it's a guaranteed residual value. Okay, and we'll talk about that in a bit. The lessor may record the initial transaction as 2 pieces. So what they might do is they might record a lease receivable based on the present value of the payment stream, and then a residual asset is what the present value of the expected residual value is called, and then they'll put that in as their future value. The change in payments creates a change in the schedule of interest and accounting for the final payment. We'll look at that in a bit. So let's look at a modified version with a residual value. The only part I modified is that Mallard expects to receive the machine with a value of $20,000 at the end of the lease term. Oh, I'm sorry. And I also did modify the payments, right? Because if they expect that $20,000 residual value, we just calculated the payments that Mallard expects. The interest rate implicit in the lease is 10% still. The fixed value, the purchase the asset for $122,034, which is also its fair value. So everything else is the same. How would you calculate? How would you classify the lease to the lessee and the lessor? How do you know? Well, nothing's changed. Remember, if we look at, well, not nothing. When we look at from the lessee's perspective, let's make sure that we still have a financing lease. Well, we do right off the bat because the lease term is still 8 years and the economic life of the leased asset is 10 years. And so we trigger criteria number 3 that the lessee will own this leased asset, or not own it, but use it for an extended major part of its economic life. Let's look at at another one, because we're going to have to anyway. We're going to have to actually calculate the present value of the lease payments in order to determine what the right of use asset is. Well, we calculated the new payment stream as $19,205. That's without a residual value to the lessee, remember, because they're not guaranteeing it. The lease term is 8 years, and my I is still 10. So I take those into consideration, calculate a present value of the lease payments made by the lessee. The present value to the lessee is going to be $112,703. To the lessor, again, because you have to do this anyway, it doesn't matter, because now we look at that from the amount of payments and the fair value of the leased asset to figure out if it's substantially all. Well, this still would meet by criteria number 4 because it comes out to about 92%. So criteria 4 is also met. Right? Again, just for practice, getting you in the mode that you should check all of the criteria, training you and getting your skill set going. But again, you do have to calculate this number anyway to do the journal entries at January 1st, 2019. And so I'd advise you to go ahead and do that. Now, for the lessor, let's go ahead and calculate what they would record as their lease receivable, because remember, they expect something a little different than the lessee, right? They have a payment stream coming to them, and that payment stream was modified because they also expect a asset of a value of $20,000 to return to them at the end of the 8 years. They still have the same I, they still have the same N, but now this present value, because of is going to still be the original, right? Now we have a lease receivable at 122,034, a lease payable that's going to be recorded at a different amount. And so I told you that in some cases, they're not going to record the same financial instrument from the lease contract. It depends what parts of it the lessor is going to capitalize. In this case, they capitalized the expected residual value of the asset, but because the lessee was not required to guarantee it, they do not record that piece. Okay. So now let's look at the journal entries required for the two companies at January 1st, 2019. In this case, because we already have the present value mapped out, we have an ROU asset that is equal to $112,703. The lessee is going to pay cash of $19,205. And we have a lease payable. Now, for the difference between them, $93,498. The lessor will record a lease receivable. And again, remember, they can do it 2 different ways. They could break it into 2 pieces. So let's look at the pieces they have here. They could look at it in terms of they have the present value of the payments. Remember, this is what the lessee promises or is going to pay them. They could record that as the lease receivable. They have the present value of the residual asset, which we had already determined on the prior page. Remember, that's just $20,000 as a FV discounted 8 years at a 10% rate. Well, then altogether, they're recording the full value of our leased asset. It's $1 off, but don't worry about $1. Well, then they also receive that first cash payment. And so after that cash payment, the total amount of the lease receivable and the residual asset would be reduced to $102,828. You could do it either way. As I said, maybe it makes more sense to you to separate the lease receivable and the residual asset. This is something new under the new standard that companies are being allowed to do. So I'm not sure what would drive such a decision for a company to do it one way or the other. But it's available now. So I just scratched that out because that would be the value of the lease receivable without deducting the $19,205. But we know that they're going to receive that amount in cash. And so we might as well reduce that from the lease receivable. And that is something that we would consider, right? And in this case, we do not have profit because the fair market value equals the cost of the leased asset. So we only have to credit the asset that we're leasing. If we just considered it all lease receivable, which I kind of suggest because it's much simpler, we would have the combined value $102,828. The cash value would be $9,330, and the leased asset would be $122,033. So either presentation is fine. You should be familiar with both presentations so that it doesn't throw you off. The lessor is going to earn interest off both the lease receivable and the residual asset. So either way you do it, that calculation is the same. So then we go to record that now. At year end, we would have some interest expense to record by the matching principal that the lessee would have to pay. And again, that's going to be the carrying value, this, times 10%. That gives me the interest expense, $9,350 after we round. And the same is true for the lessor. They take the lease receivables carrying value, multiply it by 10%. That would be interest receivable of $10,283 after rounding, and interest revenue of the same amount. The lessee would also have a right of use asset it has to amortize. In this case, the right of use asset's value has changed. It's $112,703. It's going to be divided over the lease term of 8 years, and that gives me $14,808. So we debit amortization expense, and credit an ROU asset. All right, so that is how the residual asset will affect. Now, let's look at the big picture, right? So the lease receivable now is different than the lease payable. It's greater because it contains some of this residual asset that the lessor is expected to recoup. And I made a faux pas here. I recorded the residual asset twice. This should be a cash amount of $19,205. Okay. It's bigger because it contains that residual asset. We still remove it at its historical cost, $122,033. And because the terms of the lease deal equal that, we have no sales type with profit. And then we apply the accruals at the end of the year in the fashion that we're used to by using the effective interest rate method, using the carrying value of these two financial instruments to determine the amount of interest revenue and the amount of interest expense, and the amount of amortization to apply. Okay. I want to look at the difference in the amortization tables. So I provided you with the original schedule without the residual asset. This is from the lessor's perspective. We're talking about the receivables carrying value. And then I provided you one with the residual asset. Of course, they come out at the same carrying value at the beginning of the contract, but because of the difference in the payments, remember, with the residual asset, we expect less payment to make up the total value of the asset we're leasing. So we can drop the payment sum because we're expecting this final return of the asset. So this is not a cash payment. This is just the return of leased asset at the expected value, expected residual value. Here we don't expect that return. We just have a series of payments. Notice I added a line here, 12/31/2026. There is no 12/31/2026 because in this case, the lessor did not expect the residual asset. So let's look at some other differences. Well, here we see that the payment stream, including the residual asset, is actually greater than the payment stream without. This payment stream, this total, is called the gross investment of the lessor. The present value of these payments is called the net investment. And these are required disclosures for the lessor in their financial statement footnotes. Notice another difference is that the interest revenue with the residual asset is greater than the interest revenue total without the residual asset. And the reason for that is that because we're having higher payments without the residual asset, we're paying down the receivable more quickly in the original amortization table. So less interest is accumulating over time, right? If you make higher payments, then you have less interest. That's just kind of a simple truth. Right? Well, this, because we're stretching the payments out further and we have this $20,000 residual asset collecting interest over time, we have greater interest revenue when we have a deal that has an expectation of a residual asset. The final piece of this is that there's a difference in now the closing entry, in that when the lessor receives the asset, right, then we're going to have the return of the leased asset. We're also going to have, remember, some interest revenue that's recorded during that final year. Well, remember in the original example, we made that final payment on January 1st, 2026. There is no longer any interest revenue after we make that payment. Remember, this is actually interest revenue that was recorded in 2025. Because of the way, we're doing this because it's an annuity due, it throws off the amortization table slightly. So make sure you realize that, right, this was the carrying value at 1/1/25, and it would have generated interest revenue of $1,890. That is this amount times 10%. Well, then at the beginning of the next year is when we pay that off, because remember, when we pay that off at the cash payment, we're actually paying off the payable, not interest revenue. I'm sorry, when we're receiving that, we're extinguishing interest receivable, not interest revenue at that point, right? So in this case, this amount was not interest revenue, this $33.99. This was not interest revenue during 2026. This was interest revenue that was recorded to the income statement in 2025. Then that payment paid off the interest receivable of $33.99, reduced my lease receivable to $18,184. This is the carrying value at 1/1/26. So it takes a little bit of skill to read this amortization, just to remember when we're recognizing the revenue and when we're actually making the payment, right? So make sure that you can logic through that. Well, in 2026, because we haven't paid off the asset in full, we made our last payment at 1/1/26, but the lessor is expecting to receive this asset back at a $20,000 residual value. The way you can get this value without having to do the entire amortization table is just taking what is the future value is 20,000. We're expecting to receive that a year from January 1st, 2026. I is 10%. We don't have any more payments. We made the last payment. Well, that gives me a present value of 18,184. So then let's make the final record. If we are the lessor, we have the leased asset, and we expect to get it back at 20,000. We'll talk about what happens when it doesn't come back at that amount. But if we get it back at its residual value that we expected, things are relatively simple. Now, we have a lease receivable still. In this case, our lease receivable is currently at 18,184. So the return of the leased asset gets rid of that piece of it. The other piece that's paying off is the interest the interest revenue generated from that residual asset at the end of the year, 1,818. And it's slightly off, right? But we're not going to worry about $2. What happens if the leased asset comes back at 19,000? So we had an expectation of 20,000, and we get it back. We take a fair value assessment, and we realize, well, it came back at 19. Well, in that case, we record the leased asset at its fair market value. We still extinguish all the accounts. We're not going to receive anything else. We don't have an interest. We don't have any more payments coming in. The lessee did not guarantee the residual value, so we just take what we get back. And if our expectation isn't on the money, then we would record a loss on the lease to make up for that discrepancy. Right. I'm going to stop this video there. It's a lot to chew on. This is what I want us to look over on Wednesday, and we will hopefully get some footing. I'll make sure there's some problems that we can work through. We may touch on a guaranteed residual value, but right now I just want us to get to the unguaranteed residual value, where the lessor expects the return of an asset with some value, and whether or not they get it, we'll record a loss or a gain.